uniqueness of product and uniqueness of distribution. Like, the best businesses in the world have both, but you absolutely have to have one of those. I think coming out of COVID and the reset that happened in 2022, a bunch of our companies were actually underinvesting because it was like all they heard from their investor base was like, cut. And it's like, well, we're on the precipice of this massive shift.
We are here with episode 13 of the IO podcast. This one's pretty cool. David George is a friend of ours for several years. He leads the growth investment practice at Andreessen Horowitz.
Obviously, growth is different. A lot of the folks we talk to are focused on early stage investing. So it's going to have a bit of a different flair to it just because of where David spends his time, but super impressive and should be a good combo.
Enjoy it. So we're stoked to be here in Menlo Park at Andreessen Horowitz's office, here with David George, who leads the growth fund. Tell us your story. You're a Kentucky boy, is that right?
That's right.
How does a Kentucky guy
It's the hotbed. It's the hotbed for VC and tech, right?
You know, it's so fun whenever I meet somebody else from Kentucky and California, especially in the industry, they're like,
all
whoa,
six of them.
Whoa. Yeah. It's like, you know, it's like in Back to the Future or something where like they run into themselves. They're like, how are you here? I grew up in Kentucky. You know, I'll talk about my upbringing as much as you want to, but I had a great upbringing, like awesome family. Parents are great. I had an older brother who kind of whipped me at everything we did, which I think is a big part of made me, you know,
who
I am. Yeah. Went to college at Notre Dame, and I had no idea what I wanted to do with my life. I took a job in Chicago because people were like, "Oh, go take a job in finance in Chicago." And then in Chicago, I had this like realization that I had lived in Kentucky, Indiana, and Illinois in my life. I was like, that was the fullness of my experience. And so I applied for a job in California. I'd never been to California before. I kind of cold emailed my way into a connection, got a job interview out here. First time ever going to California was
for that
job interview. So I landed. I got the job offer on the spot at dinner that night, and I accepted it. Called my family, and I'm like, hey, I'm moving to California. I'm like, wow, okay, what? I figured I wouldn't stay out for long. I met Kristen, who's my now wife, and she's from out here. I ended up going to Stanford for graduate school and got stuck.
So is that
great place to be stuck?
Great place to be stuck. So then how do you get into tech? Was it out of Stanford and investing?
Okay. Yeah. So my wife was sort of a startup person, and you know, she was an engineer working at early stage companies, and that was some of my early exposure to it. And then just being at Stanford, like you can't help but get exposure to it. And at that time, I was working at a PE firm before it, and I had a decision to make, which was like, what asset class do you want to go into? And like, it was very clear at that time, this was like 2010, that the world was going to specialization. Like you had to pick an industry, and I had narrowed it down to growth investing. I had done both growth style and private equity. I like growth better. And I was like, all right, what will have tailwinds for my career? And it was like tech, energy, and healthcare. You know, I guess I'm not good at picking three things, but fortunately I picked one thing that was good. And so I ended up, sort of getting an intro to a guy at General Atlantic while I was at Stanford, and started working at GA while I was at Stanford, and then ended up working there for a long time, for 8 years.
8 years at GA. There's probably plenty we could talk about there, but I would love to know how you end up at Andreessen, because they didn't have a growth fund. Did you help start it? Is that
right?
I
started it. Yeah. Well, I helped to start it. And you know, they didn't have a growth fund, but they had done a decent job actually at making growth investments.
Like Skype was like a growth investment.
Skype was like a PE investment.
Yeah,
that's true. What are these guys doing? And by the way, like there's a lot that we could talk about. You know, it's I'm speaking out of school because it's not mine, but you know, LPs were like, what are you guys doing?
But it was just one fund, one core venture fund.
It was a core venture fund, and they had what we called parallel funds, which was kind of like an overage for things when check sizes got a little bit bigger. And so that was kind of the de facto growth fund. But they were the last one that just hadn't done it in a first class way yet. And, you know, I knew some of the folks from a16z, just from overlapping investments. Like I was on a board with Alex Rampell. And, you know, I was an investor in Slack and Airbnb and a couple
at General Atlantic.
At GA. Yeah. And so I got to know them. And, you know, in fact, the initial push for a16z for me was from somebody that I actually didn't work with, an a16z portfolio founder, Jen Tejada from PagerDuty. And I'd gotten to know her, and a16z was like, hey, who do you all like in the industry? We're starting a growth fund. And she was like, I don't work with this guy, but I really liked him. And he's always kind of carried himself the way you all do, first class business in a first class way, treat people right, take the long view of relationships. And so got to know them in 6 to 9 months, got to know all the GPs, had a bunch of different sessions, sort of mutually, there's sort of a
falling in love.
Falling in love. And the further we got into it, they're like, okay, how would you actually design this thing? And that was so cool for me.
Well, you had never built a growth fund before, right? So how do you
I
think
managed
they get
like
comfortable?
a pod at GA. GA is awesome. We had amazing people. But I sort of managed a pod, and it was like, okay, for me personally, this is so cool. Like for a couple of reasons. One, I get to design our system and team and setup and focus and investment decision-making process. But also I get this like incredibly unfair advantage in the industry, which is we get to attach ourselves to the best VC. Well, I'm biased. I think it's the best VC firm in the industry, or one of the best VC firms in the industry, with one of the best portfolios in the industry. So I remember one of the things that we did during this get to know you process. Actually, I'll tell two parts of it. One of them was like, why don't we like simulate a deal discussion, and just come in. And so, we had some people at the time. There were 3 employees at a16z's who had worked at AppDynamics, and that was one of my investments, and it had been sold to Cisco at the time. And so it was like safe to talk about, like there's no confidential information or whatever. And I remember I was blown away. I walked into our upstairs conference room, at like 11 o'clock on the dot.
This is here?
This is here.
Yeah.
It was before I worked here. It was like a simulated investment discussion. And the room is packed. Like 11 a.m., normally like you go to some investment firm and it's like people are filing in and people are late or whatever. Like the room is there waiting. And they're like, all right, let's get started. And it was so professional. I was taken aback by it. And then the depth of the conversation, to me, it was totally different. It was not, the stuff they wanted to talk about was not like, how do you protect your downside? And what did you make of this risk? And did you think about structuring something to protect how you price the IPO or whatever? It was more about like, what do we know about this market that other people don't know, right? And like, why does this have the potential to be something much greater than what it is? And so it was a super cool experience, fun. The team there, I had all kinds of misconceptions about what the firm was all about before I joined.
What were some of those misconceptions?
Well, I thought, I had met Mark before. I didn't know Ben. But I thought Mark and Ben were like these sort of celebrity dudes, just kind of doing other stuff. And like, what do they know? What do they care about investing? Like, they're doing all this stuff. And it couldn't have been more wrong. Like, they worked so hard. Like, that was one of the things that really struck me during the process of getting to know everybody, is coming over after work at 6 o'clock or something on a Monday. And like, the halls are packed. Everybody's working hard. They're talking about how they can gang tackle an investment if they decide they want to do it. Very robust discussions about the merits of investing. And so I had that totally wrong. They're super competitive, and they're still that way, which is fun. They've had a lot of success building the firm, and I think we've had a decent amount of success kind of building individual funds inside of it. But we work our asses off. Like, everybody here works really hard.
Fascinating. So this fake investment discussion you had, is that what cinched the deal for you to join, you think? Like, is that where you knew it was the right place for you and they knew it was the right for you to join?
What really cinched the deal was a brunch that we had with our partners, with our spouses.
Okay.
And my wife, asked the really hard-hitting questions of them at that time.
Like what?
And Ben, it was sort of funny because she kind of asked, like,
she's like, let's talk Carrie.
Yeah, let's talk Carrie.
She negotiated.
Brunch, yeah.
No, she was like, talk to me about your commitment, right? Like, what are you committed to building a growth fund? Like, and then Ben always joked after the fact, and still does, that he's like, I think we hired the wrong one. You should have hired your wife, not you. But it was super cool. And at the time, like, part of my kind of reverse diligence on the firm was like, can I look at the portfolio? And they're like, sure, I assume you'll want to look at this to know, what kind of pipeline you want to build. And I was like, I already know the first 6 investments that I want to make inside the fund, like your venture fund. Like, I know which companies we want to go get. And so that was just a way to kind of get turbocharged.
How much of your excitement came, and you mentioned this, came from the fact that Andreessen has this feeder portfolio to a growth fund that is top tier, versus, like, how many of your great deals would come from that versus you could find someone outside of the portfolio? How big of an advantage is it to have?
So it's a huge advantage. So, like, it's probably obvious, but we have deep relationships. We've got a lot more game film. We can have more direct conversations about how things are actually going. It's just the advantage in a growth fund of having a venture fund.
Mm-hmm.
It comes in a lot of different forms. Like it's not just, hey, we have access to information, but there's so much exhaust that comes from our business, even the companies that we don't invest in.
Mm-hmm.
Like 90% of our investments that we make outside of the venture portfolio, we will have looked at their Series A or Series B.
Mm-hmm.
And so that's a huge advantage. And the other piece is like where I think alpha comes from, which is, there's this whole sort of like framework of investing, growth investing, right?
Yeah, we're going to talk about that, by the way. But
yeah, we can jump into it. It's like, okay, like where do you get edge, right? So the thing that we always used to say at GA is like, okay, what are the big buckets of things to care about when you're assessing an investment? Market, business model, management team, and the deal.
Yep.
And there's like a bunch of subcomponents to each of those. When I joined a16z, I made some additions and some points of emphasis, right? So the biggest addition that I made is uniqueness of the product, right? Like uniqueness of the product above all else.
Why?
Right?
Why did you make that change?
Well, one, I think understanding all of these things like market position and quality of business model comes back to how high quality the product is.
It's so funny because like you always have this emphasis on unit economics from a financial standpoint, but if you actually go farther to the core of what drives the unit economics, I think it leads you to product, which is what
product. Yeah, and like when I was at GA, like we had no ability to differentially assess a product.
Yeah,
but if you go back to what is an advantage of being attached to a venture fund, like we have very, very, very capable and smart early stage investors who know their products, know their markets, know their tech stacks. And that gives us a huge advantage. And so if you talk about like uniqueness of product, how do you figure that out? It's talking to customers, it's understanding how compelling they view it to be and doing a bunch of work on that, pricing power, gross margins, stuff like that.
Mm-hmm.
Although I think at the stage that we invest in companies, like nobody has good pricing on their products. They haven't tended to figure that out yet, but you start with that as the first thing. And the most successful investments that I've made and that we've made as a firm, I would say, have very unique products. So emphasis on the uniqueness of the product, emphasis on the market differentially, right? Business model, I think business model is like table stakes. So like there's a million blogs that you can go find on like doing cohort analysis and like CAC paybacks and like that might have been edge in 2010.
But you don't think there's any alpha in that anymore? I
don't think there's alpha in that. And I think getting it wrong, at least in my career, I haven't been surprised to the upside on like business model. I've made plenty of mistakes in my career in a lot of different ways, which we can talk about. But I do think many errors of commission in this industry happen from business model issues, like getting that wrong.
So what's an example of that?
A company that is dependent on Facebook and Google for all of their traffic, and they don't have a differentiated product. So you go back to unique. So I always start with like any investment conversation that we have. It's like uniqueness of product and uniqueness of distribution. Like the best businesses in the world have both, but you absolutely have to have one of those, right? Mm-hmm. So, if you take something like Roblox or Figma that we've been investors in, they have unique distribution, right? Because there's virality for Figma, and in the case of Roblox, there's a network effect. So it drives organic traffic. And so the best businesses have both. We've also been very successful in investing in companies that have very unique product, but not necessarily unique distribution. And I would say that a lot of sort of enterprise software would fit that bill.
One thing that I always put in that same bucket, so you're talking about there has to be product differentiation, there has to be distribution differentiation, kind of in that order. The one that I always think about that tends to lead to big outcomes too is like a different monetization strategy. It's like, hey, Expensify is over here charging for SaaS, and then Ramp, charges, it's interchange, right? Like there's a business model innovation.
Yeah,
do you put that in your criteria too?
Look, it's pretty rare to see them.
Yeah.
This was like one of the big unlocks of SaaS.
Yeah.
Right. It is a business model innovation. And, there's a bunch of reasons why perpetual license companies would struggle to adapt and compete with SaaS companies. One of which was the business model innovation. I mean, like Adobe is the famous.
Well, you're making more money, you can spend more money. Like it changes
exactly.
everything.
And it's
right?
very hard to make that shift because you're sort of pushing out your revenue recognition. And so Adobe is the famous one that went through it in the public markets and just got their asses kicked. And they made it out the other side, and it's one of the best software businesses ever. But yeah, business model innovation for sure. Like, some of the financial industry companies that we've invested in, like, Robinhood and Coinbase are business model innovation companies. And, they don't per se have uniqueness of distribution, but the innovation that they had is so profound, and competitors are unable to actually stay up with it, that it actually gives them organic distribution.
Like you think
that's huge.
Yeah, you think about Robinhood, and they removed all this friction, and like that model innovation ended up having like a distribution.
Yeah, for sure. It's what gave them organic distribution.
That's right.
And so, it's like going back to the framework, right? Where do you get the alpha? Like the business model, I don't think the alpha comes from there. The market is where you get the uniqueness of the product in the market is where you get the alpha, right? And so there's a bunch of examples of companies where we've gotten it right and gotten it wrong in understanding like what is the upside or the right side of the fan, as we call it, of like how this could go right in the market and how duration of growth could be much, much longer.
Yeah. Talk about that right side of the fan, left side of the fan framework for people who would maybe be curious about that.
Yeah. So like we're kind of investors and there's all this work that we do, which I talked to some about. But we always stare at, what we call like our investment cases, like our scenario, a range of scenarios. And we'll have, downside, base case, upside, and there's a bunch of, sometimes we'll have multiple different versions of those. But when I say right side of the fan, I mean, how can things go right? Like what are the tail outcomes of things that could work in your favor on the right side of the fan? And so our style of growth investing is pay adequate attention and focus and diligence on the right side. Like it's very tempting to focus on the left side, which is how do we protect ourselves? In a downside scenario, it seems like, oh, maybe somebody would buy this and whatever. Or, in a downside scenario, I think we'll be protected because of liquidation or whatever. There's a tendency in the growth industry, I think, to talk about that a lot and kind of have it, the right side of the fan, be kind of a throwaway thing, right? Yeah. Our style is very different. We do care about downside protection and understanding how we protect capital, and we focus on our loss rate and all that stuff as fund managers and stewards of capital. But on the right side of the fan, what can happen in the market to give you a big boost? What is something like, does the founder, I'll give you a couple examples, right? So like the case of Figma, on the right side of the fan, you could build a super simple investment model. When we made our investment, and it's like, okay, there's only so many designers in the world. And like pretty quickly you're going to run out of TAM. What that fails to acknowledge is two things. One, that's a static view of how many designers there are. It's actually growing fast. The ratio of designers to engineers was growing very fast. And number two, the function of design is very much merging with the function of engineering and even business. And so your view of the TAM is not designers. It's actually front-end engineers and actually business people, which they're seeing. And that actually leads
to a very different result. And did you identify this on the right side of the fan?
Yes.
You guys did?
Well, so there's a funny story about this, which I'll share because I deserve no credit. So when we were making our Figma, investment decision, we were debating it. We knew the price, and we were like, oh man, the price is high. And you always kind of feel that way.
And for context, when is this? What round? What?
This was the series, I can't remember if it was a Series D.
Okay.
It was at $2 billion.
Okay.
And I love Figma, and we're still very happy investors. We continue to invest in it. But the question was like, oh, is the price too high? Business quality is very high, but the price, Dylan's amazing. Is the price too high? And we had this discussion about TAM and how big can it be? And it's funny. This is the benefit of the early stage that I'm talking about with like product and market understanding.
Yeah.
Our early stage partners were like, you guys are missing the point. Like the world is going to design merging with these other functions. So like, that's great. Cute little design TAM analysis. Like, thanks for that. But it's missing the point. It's going to be something much larger. And so we had this heated debate, and we go home that night, and I'm wrestling with it, and we got to make the decision by the morning. And at the time, my wife worked at Facebook, and they were like a big Sketch user. So like Sketch was the other,
we used it at
independent company. And I remember I'd asked her about Figma before, and she's like, "Oh, you know what? Just out of nowhere, she didn't know we had the Figma discussion. She was like, "Oh, I saw Figma for the first time, in action today. I get it." And I was like, "Huh, like this is kind of a sign." And then I had a conversation, with our deal team and a couple of the early stage guys, Peter Levine, Mark and Ben, the next day, and we decided to do it. And, but like it's a good example of if you stick with just business model analysis and like a TAM that everybody else will understand and model the same way, like you're never going to get to conviction to do the right investments. So that's one example of seeing that sort of right side of the fan.
Do you have an example where you guys brainstormed, got conviction on the right side of the fan, and it did not play out at all that you'd want to share?
Of course. But I'm not going to share names because most of them are still in process. But no, it happens all the time. And look, it's a probabilistic outcome thing, right? And so we focus on inputs, not outputs in our decisions. And, one of our values is like as a growth team, I sort of created a bunch of values as a growth team. And one of them is, openly disagree, be transparent, and then commit. Yeah. Once you make it, a lot of people have that same philosophy, but I think it's really important. And so, focus on inputs, not outputs. There's plenty of examples of that. The more painful examples are the ones where I feel like, we or I failed to recognize that right side of the fan and see what could have been right.
Do you have an example of that one you'd share where you didn't see the right side and you should have done it? A deal. What's your favorite one?
DoorDash.
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 What did you miss on DoorDash?
700. We just missed we missed a bunch of stuff, but one of the big things was just the power of the trend itself. And look, you can look at DoorDash's numbers now. It's still growing very, very fast, right? Way faster than any model would have outputted. So the magnitude of the trend we missed, the strengths of Tony, we missed, and he's exceptional. I think he's one of the best founders of those kinds of businesses out there. Maybe one of the best,
if not the,
if not the. And it was one of those things where we probably over-rotated on concerns about business model and failed to see how powerful the trend would be and how the power of the trend and the scale that he would get to would allay some of the fears and concerns that we had about business quality. So there's a ton of examples of things where we've gotten it wrong.
Yeah, makes sense. I got in my notes. By the way, I talked to Alex Zimmerman on your team about what we should ask you about, and he sent a bunch of stuff. One of them is that he thought you should talk about the long-term market structure of different investments that you make in the Glengarry Ross analogy. Can you talk about how you think through that long-term market structure? And
Yeah. It's something we talk about all the time, and it's so fun. And like, I know we'll talk about AI later, but like AI market structure and all that stuff is so fun to geek out on. So there's a philosophy that we've always kind of espoused at the Growth Fund, which is, you said Glengarry Glen Ross, but it's like a power law, right? It's just a power law in most tech industries.
Andy Ratcliffe would call it like gorillas, chimps.
Exactly. And so the Glengarry Glen Ross analogy is, and oh, by the way, this exists not like network effect things. That's obvious, right? It's like, okay, Google and Facebook and all these things. With
the insight is not there. It's that it exists.
That it exists in other industries, not the network effect industries. And so, Salesforce, right? Workday, ServiceNow. Like there's a bunch of these examples where this still holds. And so, the Glengarry Glen Ross analogy is, if you've seen the movie, it's like this old school kind of boiler room movie, and these guys are sales folks, and it's Alec Baldwin, and he walks in and he's got his whole sales team in there, and he's like, okay, new contest, first prize, and he explains what the contest is. And he's first prize gets a Cadillac, second prize gets a set of steak knives, third prize you're fired. And so we actually think that most technology markets follow this power law where it's like, hey, first prize, you're going to command 80 or 90% of the market cap. Second prize, you're probably playing for scraps and you're going to be disadvantaged because most of these technology industries are scale industries. And then, third prize, like, see ya.
So would you go as far as to say that this dynamic exists by default in most tech, like most parts of tech, and it's not the opposite where it's the exception? This is actually the rule, would you say?
So I think for most areas of technology actually follow like the increasing returns of scale, right? Like the Brian Arthur concept. And again, network effect is one example of one of those, but there's many others, right? Like there's large upfront costs. And it's like the inverse of the decreasing returns of scale, or like the widget maker, where it's like, hey, there's
capitalism eventually catches up.
Yeah, there's no differentiation, and like, capital will follow profits and suck it all away. That doesn't exist in most technology markets, and there's a bunch of reasons for that. But I think the default is that's the way it plays out in most of these industries.
How much of
and so like we look, it's not that many people say they focus on market leaders. We probably overemphasize market leadership and assume more things could go right on that right side of the fan for market leaders than for the ones where you're like, okay, things.
But that puts a lot of pressure on you to determine who's going to be the market leader, right? And to know that earlier on than most folks are going to know it. Yeah. Or do you feel like you get to wait, see who's emerging and who's got a lead, and then like go in? Like, how do you think about that?
So we actually get to do both, which is, on the venture side, they're in the business of picking them early.
Mm-hmm. Yep.
And I'm very fortunate because my partners do a pretty good job of it. They've picked the right ones, right? Like my partners have picked Databricks and Coinbase and like these, like Stripe and like these exceptional companies that, then set us up to continue to proceed with them. And then there's other industries where we just didn't, for whatever reason, see it or make a bet. And so Figma is an example of that, or, Roblox or SpaceX or Flock Safety. Which were net new investments. And once we felt like we saw that they had sort of achieved that market leadership, uniqueness, business model, was going to be high quality, then we can go make the investment.
How often has it ever happened where you felt like you at the growth stage backed someone who was like a non-consensus number one, or like they were a number two, but you felt like you saw things where they were gonna go and actually win and be the category king?
Well, so there's a bunch of examples of companies where it appeared that there was another winner.
Okay.
That was like a modern winner.
Okay.
And then it turned out to not be the case. Right. And so in the case of Figma, Envision and Sketch existed already. And so, and many people made, bets on those companies. But, Figma kind of came later, and it was a much longer build. When I invested in Crowdstrike at GA, I remember we had looked at it and passed on the round before, stupidly. But when we had passed on the round before, consensus was much more in favor of like other players. Like Crowdstrike was not the declared winner. It was like Cylance was the hot company. Carbon Black was a really hot company, and a bunch of people had backed them and made big investments. And it suited us well to not follow one of those. And then we ultimately ended up investing in Crowdstrike, and that turned into one of those power law companies. But yeah, it's, back on the DoorDash point, like Postmates was around before DoorDash, right? And so they were first.
Well, and Uber Eats was, bigger for a long period of time and stuff.
For sure.
Yeah. It's always interesting to me when it looks like somebody else is going to win and then somebody else actually wins, and how can you figure, because that's a growth stage type decision.
Yeah. And there's never there's no like rule of thumb of what you see, but like architecturally Figma was a 5-year build, famously before they released the product. And it turns out that it's just a really hard build to build collaborative features. But the technology shift to SaaS and cloud actually enabled it. And so, that's what got them, and then many other things. Like they're a very special company for a lot of reasons. But yeah, there's a bunch of examples of those, and it's hard to do.
By the time someone gets to the growth stage, I assume one of the main questions you're trying to figure out is how long they can maintain this specific.
And also, when do you put somebody in the growth stage?
Yeah. Actually, talk about that.
Because a lot of people who listen are early stage. But what is growth? What are we talking about?
Yeah, it's a qualitative assessment of once a company has found product market fit.
Okay.
And so that can take a lot of different forms sometimes.
But that could be a Series A even, right?
Yeah.
So you would call some Series A growth companies? Or
yeah.
What about at Andreessen? When is someone going to be pitching you and your team for a round from Andreessen?
Well, we're very fortunate the way we operate. So we work really closely with our early stage folks. And so a very common thing that happens is we hear about a company they're raising. It's sort of it's like, oh, it's whatever. Pick a number. 8 million of revenue, growing really fast. Raising some amount that if you squint could be venture or could be growth. And we'll just see it together. Mm-hmm. And we're like, hey, let's figure it out. And we tag team it and we'll figure out later. Let's figure out the answer. And then we'll figure out later
which vehicle to use.
Yeah, which vehicle to use and who should be lead and all that stuff. So we have that luxury. I'd say in AI world now where we have made some investments that are slightly earlier. For a variety of reasons, and we have a rubric around, what constitutes something that fits. But the biggest thing is like a view on the uniqueness of the founder and their capabilities when it comes to the AI stuff. So, we're investors in character AI, we're investors in character AI and Mistral and XAI and some of these companies where it's like, okay, we're making an earlier bet than is typical. But because of the quality of the team and the magnitude of the trend, we'll
do it out of the growth.
Yeah, we'll do it out of the growth fund.
Okay, so degrading growth rates over time. Someone's growing at 300% and then 200%. Like, how do you project? And what are the best companies doing to maintain high growth rates, would you say?
It sounds like it's all going to come back to what you were talking about with the uniqueness of the product.
Yeah,
right?
Yeah,
and how long can you remain unique and I think part of the way that you're going to answer this will be like the push versus the pull thing.
Yeah.
And I would love to understand that framework and how does that tie to the uniqueness of the product?
Yeah. All right. I'm going to do a triple Lindy here. I'm going to bring 3 of my little frameworks.
Love it.
All right. So 3 frameworks. So, uniqueness of product. One of the things that we talk about when it comes to uniqueness of product is this a what innovation or a how innovation? And a what innovation is a fundamental reimagination of something that is a product. So like, an example would be Andreessen creating, completely novel products in an industry without competitors, or Databricks, right?
Creating so not
Roblox,
not Figma here. This is not
Figma.
Figma would be
because of the collaborative capabilities, which is extremely hard to build, right? It feels trivial to all of us now with like Google Docs and all the stuff we collaborate on, but at the time it was not at all.
Yeah, that's right.
And so the uniqueness of the product itself, is a what innovation. So it's like very, very, very hard to replicate.
Yeah.
A how innovation is something where the method of delivery is the innovation. So for example, early days in e-commerce, like take somebody else's product that used to sell cowboy boots at Boot Barn. And instead of selling in Boot Barn, you're going to sell it on your website. And like maybe you figure out some hacks on Facebook advertising and Google advertising for a little bit.
Yeah.
But the fundamental innovation is pretty light, right? And it's a delivery innovation as opposed to a product innovation. Like you have the same manufacturer, your mattress company, and you have the same manufacturer as every other mattress company. There's no uniqueness to your product. You just figured out that you can do the foam thing and send it in the mail, but that's going to get competed away, and it's ultimately going to be a tough story. So, the what versus the how is one of the things that we focus on a ton on uniqueness of product.
Is there ever a reason to do a how, or is that always a no-no? Like if you cannot answer the what, we're done talking about it.
It'd be very hard for us to do. Yeah, like you want because we want to invest in companies where, the firm was started for this reason. It's like invest in these people who figure out these product breakthroughs or innovations in engineering and then help them be business people.
Yep.
And so like the business people thing is more of the how thing, whereas like the, technologist is more of the what thing. And so we tend to think that you can teach a technologist how to do business stuff more so than you can teach a business person how to innovate or create new products or novel products or whatever.
I don't know. Boeing seems to be crushing it.
With their non-engineer CEO.
It's like putting me in as CEO, whatever. So, anyways, the what versus the how is a big one. You mentioned the push, the push versus the pull. So one of the ways that you can tell there's uniqueness, of product and that the product is super interesting, compelling, is if it's flying off the shelves, right? So I have a Post-it note in my office that says, is the market demanding more of my product? And it turns out like that'll help things go right. If people can't stop buying it and it's coming to you naturally, there's a viral motion, whatever. Like that's very unique and rare. And
so how does that show up? Is that like you see it in CAC, you see it in their S&M headcount, you see like
you see it organic,
organic
and CAC. And so I'm not like, we can't invest in. You'd be very limited to find only investments that have organic growth characteristics. Yep. Yeah. But you can see it on a relative basis.
Sure.
Like, hey, they're CAC. There's an organic component. There's viral components.
Yeah.
And we place a huge premium on those. And so those two things, are big inputs into that like durability of growth thing. On TAM, one of the things that I always say to my team is like, ignore the research reports, generally speaking. Like, they're probably wrong and they're probably backwards looking. So the formative experience for me in this was App Dynamics. When I invested in App Dynamics, you go to like Gartner and IDC and all these places, and they're like, this market size is $2 billion, APM. And you're like, okay, that's interesting. And then you go in and you talk to App Dynamics, and it's like they have a travel customer, a financial services customer, a healthcare customer, an insurance company, and a tech customer, all paying multiple millions of dollars per year. Mm-hmm. And you're like, wait a minute. Okay, it seems like you can extrapolate that to the broader market. And yet the prevailing wisdom is that this is like a $2 billion market size, like something is off. And so we always say like, okay, take a first principles view of building out what the market size can be. And that will allow you to actually see a little bit more durability. I'm like constantly, I always say, like, I have these dumb sayings in our meetings, but like one of them is like, don't let your theory outsmart the traction. And so it's like, we can have these theories about what a market's going to be,
but the market wins.
Pay attention to what the market's actually doing.
Go ahead.
So like, I've wondered about this particularly because sometimes I think that the push versus the pull thing, when things are getting pulled out of you, a lot of times that's a trend specific thing. Like, hey, COVID shut the world down and this thing's flying off the shelf, but a company never learned how to push their own thing. And so as soon as whatever tailwinds were propelling them stop, they get screwed. Yeah. And so like, do you think about that at all? And by the way, I probably bias this way because I understand push a little bit better than I understand pull, but I'm curious if you think there's virtues of that or if it's all vice.
Look, I go back to like, what's a better starting point to have, right?
Sure.
So like the pull with learning how to push is a way better starting point than a push capability.
Trying to figure out how to get some pull.
It's like we always said this about software, and I think this has changed a little bit post-COVID, and like reset in the market and like tightening up the belt and stuff.
Yeah.
But we would always bias to the things that have the bottoms up traction. And then, say like, okay, you can hire and teach people how to do enterprise selling.
Sure.
But like, it's really hard to captivate a community and to get, that bottoms up love and traction.
Yep.
And so, if you made us pick or me pick, we'd pick the bottoms up or the organic and understand that you'll figure out how to do those.
So if I made the argument that like, if you learn how to push, you will have that muscle and you'll be able to push forever and maintain, great growth rates for a long, long time. You'd say like, maybe.
Well, there's exceptions. So I'll give you so ServiceNow and Workday are great ones, actually. So ServiceNow was just, it's one of the best execution companies like in modern software. It's incredible. I think Workday is maybe even a better example because it was like, there was no bottoms up thing, but it was like, these are the guys. Like, PeopleSoft, like they are the ones, they have all the relationships in the enterprise. They know how to build the product. Like they're the ones to go sell this.
Yeah.
And so sure, that's a different thesis.
Yeah.
But that's a thesis like based on their superpowers and the uniqueness of them.
Yeah.
Samsara is another example of that in our own portfolio where it's like, hey, the Meraki guys, like they know how to build products. They know how to build sales forces.
Yeah.
Like they've figured out the market. Like, it's going to be a push.
Yep, fair enough.
And it can still be a great company.
Yep, love that.
So for those who are watching, you guys have got to check out David's some of the content he and the a16z team produces. We're going to talk about a couple of these. One of them I'd love to dive in on is how founders should think through their R&D spend. Can you give the team...
Give us the magic number.
Give us a quick framework
you're
on
like
how...
giggling because you're like, so yeah. All right. So I wrote this piece about R&D spend and
it's great.
How to frame it.
We're going to link to it.
Yeah. Well, so look, it's not an answer, but hopefully it's a framework, right? And so I was struck by this. observation and talking to founders and management teams and sitting in board meetings and doing all this stuff, like the rigor around go-to-market spend and ROIs and like the precision of tracking of every dollar that goes into go-to-market spend as compared to the rigor and tracking and understanding of the dollar that goes into R&D. There's many good reasons why this is the case. Look, everything in a company is in service of delivering the product to the customer, right? So nothing's more important than R&D. And so I was always struck though, where it's like, we're in these meetings and it's like, okay, here's our budget for next year. And it's like, we're going to spend $40 million on R&D. And it's like, okay, 40, like why 40, not 50 or 30 or 25 or 60? And it's like, oh, well, we've got all these people and we got these things and we're going to do these things. And so the thing that I wrote was basically just like, hey, here's a high level framework of how to approach it. So it's like, start out by benchmarking companies your size. And we shared benchmarking data from our own portfolio in the piece. It's just like, how much do people generally spend? And there's good reasons to spend more or less, depending on the circumstances in your market.
But you give them a starting point, and then
there's
they can
a
argue
starting
from
point
that.
at least. And then make an effort to attach product roadmap initiatives to an ROI, right? Like, and so, there's this like commonly held thing, 70-20-10, like people talk about like, 70% of your R&D in your core product, 20% in the second product and like 10% on speculative stuff. Like sometimes that's right, but that should be an output, not an input, right? Like that should be an output of like, what's important for you? Like what's happening in your market? Sometimes you should spend all your money on the core product or 20% of your money on the core product, but like start to, sort of be deliberate about how much you're doing. And then paybacks are long. Like the reason that go-to-market is so easy to append these financial metrics to is because you get feedback in a quarter. It's like, hey, we hired these reps and they're ramping and it took 6 months, but like they didn't hit quota and some did, and these ones are good and these ones are bad in this region and that. The feedback loops are longer in product, but try and push yourself to, even if it's a 2-year payback or a 3-year payback or a 5-year payback, even attach some metrics to it. And then from there, it's like performance manage it in a rigorous way. Where you can have, goals. And I think, in fairness, companies are probably pretty good at that last piece. But anyway, that's the framework.
Love it.
Rant over.
It's a great thought. And I am curious, do you think it has to have longer feedback loops? Is that just a reality of something? Like, sure, you talk about a quarter, like, can we not have second or third products that we start to get usage on or start to see early signal on? Or should we just surrender and say, like, this is a 3-year thing?
No. Like this is the last piece, right? It's like, so it's so dependent on like how long of an initiative it is, right? Yeah. But like, just push yourself, even if it's a long initiative. Push yourself, like to show what are the interim milestones that we're going to hit,
and put those interim milestones in place,
and then performance manage them. And again, this is the piece where I think like product and engineering management are pretty good at that. Sure, but it's more of like the marrying it to finance and overall investment decisions.
Yep,
so,
totally.
And by the way, I think coming out of COVID and the reset that happened in 2022. A bunch of our companies were actually underinvesting because it was like all they heard from their investor base was like cut. And it's like, well, we're on the precipice of this massive shift, to AI. And for most of our companies, there's some potential benefit or product that they can go push on. But make sure that you're being deliberate about it.
Sometimes it can be broken thinking. Like if you think that just by being efficient, you somehow win. You can fail by being too efficient just as easily as you can by over-investing. So it's like you have to understand what you're going for. Yeah.
There was one specific board meeting that like lit the lamp for me, which was it was a company that they're awesome, man. They had modes. They have Product Mojo. They've subsequently sold, but they had like great product, and like they were awesome at it. And the founders were product guys. And it was like all of the conversation in the board meeting. And this was like kind of after they had done the hard work, like the shit work, which is like the cut and like it sucks and negotiating your cloud bill and all this stuff. And it was still all about like, look at our efficiency. And it was like, whoa, guys, like you can get back to the fun stuff, like you ensured your survival. Yeah. And so that's sort of like, I don't know. That was when it dawned on me to maybe start talking about it a little bit.
Yep. Another big debate I'd love you to weigh in on is what it takes to go public today. You've got the Coatue guys who have their thing on like 10 trillion in revenue you got to get to. And then others who say, no, the markets are open at any time. You just have to price it appropriately. And what does it take to go public today, would you say? Where do you stand on this?
I think it's, look, the N of the stuff that we're talking about is so small. So like looking back at the historical trends, like it's impossible. There's no we have subsequent data to templatize this. I wrote a piece about this, which is just like keep it super simple. There's 3 things that you need to have. One is, can you grow for an extended period of time at a high rate? And like
high rate as defined by you being.
So I think for the kinds of companies that are in our world, it's like you got to be growing, and I'll get to sizing and stuff, but like 30% plus at least, and like a path to maintaining that high growth. And I said in the piece, a story that's quantitative and qualitative that will allow an investor to build a model that in year 6, you're still growing north of 20%.
Yeah.
Okay.
Now that's a high bar.
Yeah.
But like, and it may be, more on the upside case land, but for the companies that are in our world, like they're going to want to show like, hey, investor, like here's a way to dream. And so, companies that are close to me that I think did a really good job of this is Crowdstrike. Like Crowdstrike sort of articulated this, this very clear thesis of becoming a platform company from a product company. And they've reported on that over time. They've done a great job with it. And so investors understand the algorithm and
reward them for it.
Yeah. And it's like, it's straightforward for them. Airbnb, it's core market, network effect, global, one of the best business models of all time. Plenty of TAM to go get, and investors don't have to squint to see a lot of it. And then another one that I really like is Nubank, which is my old roommate from Stanford, David, is the founder, and he's done an extraordinary job. But I think among the companies that have gone public, like they did the best job of laying out what their growth equation is, like mathematically. It's like, hey, we're going to add more products. We're going to go get a bunch more people in all these different geographies. We're going to get into B2B. And it's like a really simple and clear spoon-fed way for an investor to be like, yeah, year 6 of my model is definitely going to be growing north of 20%. So durability of that growth, allow the investor to dream is part 1. Part 2 is operating leverage. The rules of thumb that I gave, it's like, this is guidelines. If you're north of $100 million of revenue, you should be growing your expenses less than your revenue. So if you're growing your revenue at 60%, you should not be growing your expenses at 60%. By the time that you're going public, your expense growth should be, again, it depends on like maturity and growth rate and all that stuff, but like 85% of your growth rate. So if you're growing, 30%, 85% times 30%, you shouldn't be growing your expenses more. So go in the right direction so that investors can think about profitability, in time in their models. And then the last one, which I think is the biggest reason why I think companies need to be kind of big to go public, is the bar for predictability and forecastability is extraordinarily high right now. And I don't think that's actually going to change. Like, there's a bunch of reasons why that's the case. But, if you look at companies that hit their numbers all 4 quarters compared to companies that missed in one of their first 4 quarters or missed in more than one of their first 4 quarters, the difference in stock performance is 20 to 40%. And we've probably all got examples in our lives of these companies that went out and they missed their numbers, and it's like penalty box, investors aren't going to pay attention to it. And so that's the reason that I think you end up with this threshold size, because to have that kind of precision and predictability, like you got to be kind of big. And so those are the 3 things, I try to make it constructive. I try not to make it about like capital markets conditions and the election. Like, I think that all that stuff is stupid. Like, control what you can control and, ignore the rest. So that's the framework.
Awesome.
Let's do the wrap-ups.
All right. Good. So I would love, before we get into wrap-ups, how do you think, and AI is the question everyone talks about, but how do you think this market structure evolves, and foundational models versus application layer? And how do you think about where the value is going to be created? Where do you get most excited? There's 10 questions there, but like, how are you thinking about things?
I did this interview with Mark Casey recently, who's like this, he's one of my favorite investors from Capital Group. And it's like clock was ticking and we had like 30 seconds left. And I'm like, all right, now do AI.
Yeah. That's about what I just did for you.
I'll give a couple of observations and maybe ways to think about it. First of all, like it's pretty well covered, the power of this technology, but it's 10,000 times better or 10,000 times cheaper at doing certain things than humans. And it uses like 10,000 times more power to do those things than humans, like than our brains. And so on the former, I think it's going to continue to get better at more and more of those tasks. Today, it's things where, absolute precision doesn't matter as much, right? Because of hallucinations and things like that. But there's a lot of stuff that it can do today. And then that 10,000 times less efficient thing, a lot of people are working on that problem. And it's going to get a lot better.
That'll get solved likely.
It doesn't even need it. I mean, look, it's already pretty good. Like the cost of doing all this stuff is pretty low. And the cost of accessing the foundation models is just rapidly declining, which is great for the industry. So that's like the magic, and so the promise, we're very bullish. We've made a ton of investments. I mentioned a bunch of them earlier. I'm very confident that there's going to be a tremendous amount of value created at the application layer. And so if you look at demand signals, they're extraordinary for a pretty raw technology still, right? So one that we always talk about in our team meetings is like Accenture. Accenture is one of the biggest AI companies because they, their run rating like $4 billion in their Gen AI practice. So like demand signals are huge. Like they're extraordinary. I think the capabilities are already closing in fast on, reasoning and accuracy and planning, memory. And so I'm very bullish at the application layer. I have sort of a 2x2 of market conditions right now in enterprise. One is like, are you selling an AI product or not? And then another is, are you a consolidating vendor or not? And so if you are a consolidating vendor selling an AI product, it's flying, right? And so, one of the stats I got from a friend of mine is like, I think it's the Fortune 7 or Magnificent 7 or whatever. They've added double the market cap of the Fortune 493 since ChatGPT.
It's wild.
And so it's like the consolidating vendors are having a field day because there's a top-down mandate to go figure out AI stuff, go buy stuff. For challenger vendors, so non-consolidating vendors selling AI stuff, it's actually pretty good too, because there's a lot of experimental budget to go get. And again, there's like demand for these applications. There's examples of companies that are, in the other two categories, but suffice to say, it's a little bit tougher, right? And so, overall IT trends and tech trends are all kind of healthy again, but like all the growth is coming on the AI side. And, it's sort of all early business apps. On that incumbent piece, I think there's sort of two phases. So my partner, Alex Rampell, has this saying, which is, can the startup get to distribution before the incumbent finds innovation? And so where we are in phase one of this technology is it's actually pretty easy if you're an incumbent just to plug it in. It's like a chatbot.
Put AI on your product, slap it on.
Put AI, charge more, hey, our core product's not that good, but like pay us more and you can get the good.
Because you have the distribution.
Because you have distribution. I happen to think that that's just like a phase one thing. And, like the future of AI is not chatbots. Like we got to do better. It's going to be way better. And when you start thinking beyond that, there's a sort of notion that we have, which is like a complete reimagination of what the product itself actually is and how you engage with it and what function it takes, what data it accesses. And so all of those things make me very bullish for startups and newcomers to be able to carve out a space. But where we're at in the technology itself today very much favors the incumbents. Mark has a great way of describing it, which is he says, is the AI going to be frosting or sugar? And so, if you think about like baking a cake, like if it's like today it's frosting, you just throw it on top, right? It's like
it's the lipstick on a pig thing.
Yeah, it's like a lipstick and you throw it on and like
that's what he means by frosting though, right?
Yeah, frosting. It's like it's you can put it on top of today's product. It's not a fundamental ingredient, right? So like Adobe's Firefly thing, is an example of that. Obviously the co-pilots in GitHub and Microsoft, And there's a bunch of examples of these, and companies are doing a really good job to take advantage of that demand. We happen to think that it's going to be sugar. And so you can't, if it's sugar, you have to put the sugar in
from scratch.
Like you can't bake the cake and then add the sugar
and
it's
hurts
still a cake.
Incumbents.
And
that's
that hurts
very
incumbents.
hard for them.
And so like today, you can't point a finger at like what is going to be that thing. But for SaaS and cloud, and the internet, those things did actually favor the newcomers a little bit.
Yeah.
And so, that's the like high level AI thing. I think it's premature to speculate on value capture by the model layer, or, who's going to be the winners and losers in market structure. It's all so early and so fast evolving. But it's, it's very exciting.
I love the frosting sugar analogy.
Yeah, it's great.
All right, take us home, Sterling.
Well, so we have questions that we ask everybody. So there's a couple of them. First one is who is, we usually ask who's the entrepreneur you admire the most.
Mm-hmm.
You probably have a lot of favorites. Let's just talk about one that you admire greatly.
Oh, dude, I can't do one. Come on.
A couple, 3.
You can throw out a couple if you need to.
All right. So I mentioned this earlier, but I have a soft spot for CEOs, founders who, and we as a firm designed our firm in this way, for founders who are technical, who become commercial killers. Yeah. And so there's a few in my life that I've been fortunate to work with. David Baszucki from Roblox is unbelievable example of this. He's technical, brilliant, mission driven, and it turns out like he's super competitive. And he's been remarkable. He's done a great job. My prior life, and I've stayed really close with him, George Kurtz from Crowdstrike, is remarkable. I mean, he's an absolute savage. Like I'll still, they've had all the success. They've stomped on their competitors, and I'll text him after an earnings or something, and he's like, "Take no prisoners," like he's this guy. I'll tell you,
quotes coming out of earnings are always just money.
He's a beast.
Whenever he talks about competitors,
he's my favorite thing about him is when he went public. He's like they celebrated, whatever, and then he was like, 100 customers in 100 days. It was like literally like next day. He's like, I'm going to go see 100 customers in 100 days. Like work doesn't stop. Like he's relentless. And then, more recently, one of the CEOs that I'm closest with is Ali Goetze from Databricks. And, he's like I don't know what the right comparison for him is, but like Larry Ellison or something. Yeah. Like he's a ruthless competitor who is technically brilliant, top of his field, and super rare.
Second question is the same thing, but for investors. And you can't pick anyone who works in the building.
Yeah, I'm not picking anybody that works in the building. I love them for a lot of reasons. I knew this question was coming. It's a really hard one because I feel like I've learned components of a lot of different things from a lot of different people, right? Like I feel like I learn a lot from my early stage partners and other ones I know from public investors, even like value investors. Like I just like it's such a fun industry because you learn, you get exposure to people who are like really good at structuring or downside protection, or really good at seeing a future trend, or really good at assessing people. So the one that I wanted to mention is a person who early in my time at GA taught me something really important. This guy, Dave Hodgson. He's like totally underrated. OG of GA. I think he started in 1980 or something like that. He taught me the art of like subtle influence and subtle persuasion, picking your spots, balance. I got to work on this company TriNet with him, which, there's all these HR startups, now that are super hot, but TriNet is like an OG, really hot one. And so I spent many years working with Dave on TriNet, and I feel like I learned a ton from him in the boardroom.
That's awesome. And then the last question is what we call the golden spur question, but what makes you the way you are? Why do you care about this? Why do you charge at this? Like what's
driving you?
Yeah, it's sort of funny. My wife always asks, like, why are you the way you are? And I'm like, that's a negative.
That's so weird. My wife asks me that too. It's wild.
It's like a negative framing of what you're trying to get at. Look, I mentioned this earlier. Like, I think I'm super competitive, and so I think that comes back to like my childhood and playing. My brother's 2.5 years older than me, You know, if he was in the room, he'd be like, I'm taller than you too. And, you know, like it'd be like those kinds of things. But I think, you know, my formative years were like being super competitive with him. And then for whatever reason, maybe it's like losing and still getting back out there or something has built some resolve and discipline and competitive spirit within me. So I think that's a big part of it. You know, I was like a wrestler in high school, which is like the ultimate, you know, like you either get your hand raised or not. Like there's no other, you know, there's no other thing. So I've always loved competition. The crazy thing about our business is like there are a few different scoreboards. You know, one of the scoreboards is like, are you doing a good job in the community and the founders, and do people, you know, like, you know, we always used to measure founder NPS and all this stuff. But there is a scoreboard in our business, which is like
DPI
returns. And so I tell the team all the time, like, you know, one of our values is like, we win and like, we're the freaking Yankees, and like, there's a scoreboard and there's a good cause behind it. Like, but there's a competition and it's going to be measured. And that gets me excited.
This has been awesome, man. We could go on for a long time, but thank you for giving us the deep dive, and thanks for having us.
Thanks for having me. Great to be with you all.
Just wrapped up the episode with David. There were a bunch of things that really stood out, but what were some of your top takeaways?
I'm looking at some of my notes, but the thing that stands out at a high level is how valuable a lot of the frameworks he has are for investing. I loved his concept of how to think through R&D spend and apply the same amount of rigor as you would to a go-to-market team. I loved how he thinks about what it takes to go public. You know, he didn't wade into the stuff you can't control. He said, focus on what you can control, and it's growing at X%. What was it, 6 years out, 25% growth rate? Having these types of benchmarks for growth stage, call it Series B plus founders, I think is a very valuable part of that combo.
I really liked the push versus pull debate, and understanding what are problems that really can't be taught. And so from his perspective, so you think about how founders can navigate that stuff, and push versus pull was one of those. Sugar versus frosting was another one of those, in terms of what is baked into your product versus what is layered on top, especially when you go through big shifts in technology like we're experiencing now. But those were two of like my favorite.
Another
things.
thing that stood out to me is how much David and Andreessen and Horowitz largely focuses on the product.
Yeah.
Like a lot of financial investors may not want to dive in to the actual product and how it creates value, but his emphasis is on thinking through what makes an amazing product, which is not something you're going to see from a normal hedge fund or a later stage private equity. These are product people.
He gave almost no credit to the business differentiation per se. It was all about how different is the product, and is it going to remain different, because that's the push versus pull. So I loved his thinking there.
One last thing is how well he kind of lives and talked about these Andreessen Horowitz cultural principles, like long-term relationships, taking a long view of all relationships. This conversation was an example of that. I've known David for like 5+ years, and we've just kept loosely in touch, but he's always been very kind, very gracious with his time. They only do first-class business in a first-class way. It's funny, David was getting out of a very cool pitch he was telling us about, and how they were trying to win over a founder. And it's fun to see how this org operates at a very high level.
Told us some really cool stories about previous deals and how do you win them, and like the tenacity, competition at this level of the game. Anyway, it was a great combo.
Hope you guys enjoyed it, and let us know what you think.